I'm a little bit embarrassed by some of the videos I've made in the last couple of years, where I've advised people to cut back on their spending, eat noodles rather than steak, stockpile goods that don't expire, and in general just try to save as much money as possible. When all of this time, I knew the real secret to building wealth and managing money. And how did I know this? Well, I had a $100 million mentor who gave me his system to manage money. And not only does he use it, but many of his wealthy friends use it as well. And ironically, it's not complicated. In fact, it's one of the easiest systems to managing money that I've ever seen. But for some reason, the last couple of years, I've kept it in my back pocket. Well, that ends today. Because today, I'm going to share with you my $100 million mentor's system for managing money and building wealth. And the best part of this system is anybody can do it. But before we get into it, my name is Nolan Matthias, and if you want to thrive financially, this is the place for you. So go ahead, click that subscribe button and hit that like button so more people like you can see this video. Okay, so let me give you the backstory of how I discovered this system. I have a mentor who is a real estate investor, an entrepreneur, and who founded a company that does over $100 million a year in revenues and has done billions of dollars in revenues since it was founded in the early 80s. And several years ago, he gave me his system for managing money in order to build wealth. And it is a really simple system. And it is the exact system that I've used since in order to run both my business and our personal finances. And the beauty of it is it works. And it works really, really well. And no, it's not all about budgeting or paying off high interest credit card debt or trying to live a frugal lifestyle, although all of those things make up a small part of it. But it is really a simple system that is designed off of a single graph that anybody can follow along with and use in order to build their own wealth. And by understanding just 3 simple concepts, you'll be able to unleash your financial potential and build your net worth with almost complete certainty. So let me start by showing you the graph that he drew out for me the very first time we ever talked about these concepts. And it is so simple to understand. So like all financial graphs, this one starts with time and money. The x-axis being time and the y-axis being money. And what my mentor suggested to me is that all people, first and foremost, when it comes to managing their money, need to establish a baseline. And that baseline is all of their monthly expenses, their mortgage payment or their rent, their car payments, their food budget, their taxes, the gas that they put in their car, their heating expenses, their electricity expenses, and their minimum monthly payments on any debt that they have. And the total of all these commitments is your monthly baseline. This is the amount of money that you have to pay every single month. You have no other options but to make those payments, or otherwise you go into bankruptcy. And then what he suggested to me is that you want to take that baseline and you want to try to reduce it as much as possible. So this is where the savings piece comes into play. Some people may want to sell cars that have loans on them, reduce credit card debt. And then he said the first secret of this system is to keep your baseline low for as long as possible. Because the mistake that most people make when it comes to their finances is when their income goes up, so too does their baseline. They start to spend more as they start to make more. He said, as you start to get an income and your income starts to increase, you want to try to keep your living expenses and all of your obligations exactly the same, if not lower. And in doing this, you're creating a gap between your baseline and your income. And when you create that gap, all the money in between becomes money that you can invest. And the greater that gap becomes, the more money you have in order to invest. But then he said the second big mistake that people make when it comes to their finances is that they expect that their income is going to go up in a straight line forever over the long run. And people fail to realize that there will come a time when your income starts to go down. This is typically around retirement. So what you do with your investments is so strategically important to your personal finances. Because the big distinction that he made to me was that your investments should be designed in order to replace your income reliably. And rather than live off reduced income at retirement, what he suggested is that your investments should be so good that they generate so much income that you get to wake up and do whatever you want in the morning, whether you're retired or not. Now, at this point, he told me that there's 3 secrets to making this work. The first and foremost is to scale your income. So many people will go, they'll get a job, and then they will try to work up the ranks within their organization, slowly getting raises a little bit at a time. And he said, well, that works for some. The focus for those who really want to thrive financially should be to get a scalable income, one that is performance-based, and the more work you put in, the more you get out. And the reason why this is so important is because this is the fastest way to widen the gap between your baseline and your income. And what he told me is there's 3 ways to do this. The first is to get a job where you're paid based on performance. So maybe it's a sales job, or maybe it's a job where there's certain metrics and you know that if you hit those metrics, you will get bonuses and therefore have a significantly greater income. You don't want to be working based on hourly wage or working based on a salary with no bonus or scalable compensation. You need to have the ability to put in more work and make more money. And he suggested that you certainly don't want to be in a job where your performance pay is based on a group or other people on your team. You want to have sole control over how much you earn based on how much you put in. Now, the second way he suggested that you can scale your income is becoming self-employed. Now, what he suggested as well is that you can also do this while having a full-time job. You can have what's now called a side hustle. Now, side hustle wasn't a popular term when he told me this strategy, but that's very much what it is. It is a side hustle. And if you find a way to supplement your income, then you have that scalability. And I have many friends who've gone on to quit their day jobs because they had massively successful side hustles that became businesses. I have one friend who started a beauty company. I have another friend who was doing custom golf clubs. And I have another friend who started a real estate training business as a side hustle, and now it is all he does. And all of these people had one thing in common. They started with the desire to earn a little bit of extra income, and in the end, they created massively successful businesses. But you don't have to have a massively successful business in order to have a side hustle that scales your income. A lot of people just do the things that they love in order to earn extra money. Some of them go on to places like Fiverr where they can do things like graphic design or writing or editing and earn an extra income that way, or do things in their community that they know will earn them an extra income as well. And that leads us into the third way to scale an income, which is by becoming a business owner. Now, obviously, my mentor and myself are both in this category. And being a business owner is the single fastest way to scale your income and to actually build wealth. And it's my belief that anybody who really wants to thrive financially, deep down, really wants to do the work and make a ton more money, should be a business owner. Because this is the way to be in charge of your own destiny and build out a business to $1 million or $10 million, or in the case of my mentor, $100 million. And the difference between the people who have done this and the people who dream about it is simply that the people who have done it made the decision and then had the audacity of personality to go ahead and forge forward when others told them that they couldn't. So that first basic concept of the system is to develop a scalable income, whether that is working for somebody else, having a side hustle, or starting a business of your own. Now, the second piece is to start investing. And obviously my mentor, he was a real estate investor, so he believed in real estate as an investment. And he had a really great structure for doing this, which I'll show you a little bit later on at the end of this video. In fact, it was almost a risk-free structure that allowed him to own multifamily real estate land and ultimately become a developer of commercial real estate. But he had some really interesting advice when it came to investing, and it is not the traditional advice. First and foremost, he suggested that the number one place that you should be investing is in yourself. Because if you are going to have a scalable income, whether it's in a sales job or whether it's in running your own business, the way to exponentially increase your income is to make yourself better and make yourself more valuable. And I can tell you firsthand, over the last 5 years, I've invested hundreds of thousands of dollars in personal development courses and books and the like, and this has been the best money that I've ever spent. In fact, I've rarely taken a course where my return on investment wasn't at least tenfold what I paid. And that includes the Darren Hardy Business Masterclass that I paid almost $17,000 to attend. So his advice was, before you invest in anything, invest in yourself and invest in your skills. And that includes all sorts of things that'll help you increase your income, like university, sales courses, and the like. And the second important thing he told me when it comes to investing is to only invest in things that you understand. He said one of the most common ways that people lose money is investing in things that they don't understand. And if you don't believe me, go ahead and take a look at the video I made on investing in silver and gold. Dig into the comments. There are a lot of people that are going to lose a lot of money by having their money invested in silver and gold rather than other things that generate greater returns. And there's a lot of people out there that don't understand why they're investing in silver and gold or whether or not it's actually a really good investment. I'll link to that video at the end. But there's other things that people put their money into that they don't understand as well. There's lots of opportunities for people to throw their money at real estate investments that they don't really understand, hoping to just get in on that real estate bug that a whole bunch of people they know have made a ton of money at. And by the way, that's one of the single fastest ways to lose your money, is investing in high-risk real estate developments. So he was really adamant that you only invest in things you understand. Buying a home, putting some renters into it, having a mortgage, paying off debt, that's easy to understand. Investing in the S&P 500 via an ETF, that's super easy to understand. Trading options, on the other hand, is really difficult to understand. It takes a lot of sophistication, and if you don't understand it, you probably shouldn't do it. Same thing with Forex. So having sufficient knowledge in the things you're investing in is hugely, hugely important. And it helps reduce your risk, which we'll talk about in a second. But then the third thing that he told me people should be investing in is in their own businesses. And this is the single biggest payoff that somebody can have, is making investments in a business that you own completely, that you get all the returns of. And there's a couple reasons why this works so well. First and foremost, you aren't going to waste your money pumping it into a business that you know doesn't work. And when you pump your money into your own business, you're going to do everything you can to make sure that that money is not wasted and that there is a payoff. And on top of that, you are completely in control of it. In comparison to investing in somebody else's business, you don't have somebody who's going to go buy fast cars or take expensive trips on your dime because you know that it is your money and you know that you don't want to waste it. And investing in your own business, whether it's a real estate business or some other sort of business, also allows you to scale your income, which again widens that gap between your baseline and your income. And then the third concept that he talked about with me was reducing risk. And this was probably the most important concept that is lost on a lot of people. And he said, first and foremost, wealthy people never lose money, or at least they set themselves up so it's highly unlikely that they will lose it. He said a penny saved is better than 2 pennies earned, which is why he tries to do everything to minimize his risk on his investments. The second thing he suggested, which was important early on in his career and is important early on in building wealth, was to eliminate high interest debt. He said anybody who has high interest credit card or line of credit debt is already way behind when it comes to building wealth. And until they get out of that credit card debt, the chances of them actually building wealth is slim to none. Now, many people try to build wealth in order to get out of debt, but he said that's not the way to do it. You need to get rid of the debt before you start to make any sort of progress with respect to building your net worth at any sort of speed. And then last but not least, the one that was most interesting to me was he suggested that you pay off any debt that was used to buy assets as quickly as possible. Now, this had some really interesting undertones, especially when it comes to investing in real estate, because many people believe that when it comes to investing in real estate, if they put 20% down and then they put a renter in, that renter will start to pay off debt, you're reducing your risk, and eventually you'll end up with a property that's paid off. But he looked at it a little bit differently. He said you don't want to be purchasing any sort of property where you can't add at least 20% of the value to it when you purchase it. So for him, it wasn't about buying a good property that cash flowed. It was about buying an okay property that he could improve, that would have minimal debt on it and would have a significant amount of cash flow. And then rather than trying to refinance at 80% loan to value every single time he bought a new property, what he was trying to do was he was trying to keep his debt below 65% loan to value, or 65% of the total value of the properties, at all times. He said keeping it at that level basically made it impossible for him to find himself in a situation where if the real estate market turned, he would find himself in a position where he had financial uncertainty. And once he had acquired enough properties in order to replace the income that he was making from his business, he then used all of the income that he was making from all of his properties in order to start paying one property off at a time. And he got to the point where he was able to pay off a property every single year without fail. And what that allowed him to do was buy a property every single year that he knew would be paid off the following year. And at that point in time, it created a snowball effect where he was able to acquire so much property because of the amount of income that they were generating from his investments that his future income essentially became infinite. And even though he had 15 or 30-year mortgages on a lot of these properties, he was getting them paid off in 1, 2, 3 years. And even though his accountants were saying, well, hey, there's some tax advantage to having mortgages on these, he didn't really care so much about the tax advantage. He just wanted to have them free and clear because he put reducing his risk ahead of having tax advantages. And the single most important thing when it comes to reducing risk is eliminating debt. If you have no debt and you don't owe anybody any money, it doesn't matter what happens in the economy. It doesn't matter what happens with inflation. It doesn't matter if there's a recession because you will always be fine. And then he went on to tell me how he structures his portfolio. And this is really important. He called this his Evergreen investment pyramid. And it's structured in such a way that it reduces risk to almost zero. So how he explained this to me is you want to start, obviously, 18, 19 years old, you're fresh out of school. You want to start by getting an income. And once you've established your income, you want to start having savings. And what he called this was his rainy day fund. And then from there, once he had a rainy day fund, so a certain amount of money that made him comfortable in his bank account so that he could do whatever he wanted to, then he started investing in his registered savings accounts. So these are things like a 401k or a Roth IRA or an RSP or a TFSA if you're in Canada. And those accounts allowed him to purchase properties and purchase investments at a tax advantage. And once he had established those, he went on to buy a house. Obviously, he doesn't live in it anymore, but he lived in it for quite some time, almost 20 years. And the reason why he stayed in that house was because he was doing what he suggested at the beginning, which is keeping his baseline low. He was trying to keep his costs as low as possible so that all of his money could be pushed into investments so he could get to that point where, like I talked about a moment ago, he could buy properties that basically paid themselves off in a year. And that was the next step after he bought his house. He started buying single-family homes, which he rented out. And once he got to the point where those single-family homes were nearly paid off, then he used the income and some of the equity in those properties to buy multifamily homes. So those are things like apartment buildings, duplexes, triplexes, fourplexes. And once he had acquired several of those and they were paying themselves off pretty rapidly, then he started to buy land, which he then went on to develop into commercial real estate, which generated him far more than his $100 million revenue business ever could. But what he pointed out to me is that he still owned the single family homes. He still owned the multifamily homes. He still owned some land, and he still had all of his registered investment accounts. In fact, he had a pretty significant stock portfolio, and the reason why is because on this pyramid, all of the things at the bottom support the things at the top. And he told me if you take any piece out of the middle, or if you skip certain steps, you risk the whole thing collapsing. And even though he had a 9-figure net worth, he was very clear in the fact that he still owned those single family homes. The reason why was because if he ever needed a quick $400,000, $500,000, $600,000, he could take one of them and sell them and know that he could make the payment on whatever it was on the thing above it that needed an extra injection of cash. Now, not everybody's going to be into real estate, but the reason why he liked real estate and the reason why I like real estate is because it's really easy to figure out how much a home will generate in cash flow once it's paid off, and then to figure out how many properties you need to own. All you have to do is divide your income by the amount of cash flow that you expect your properties to produce, and that gives you the amount of properties that you need to own in order to retire without reducing your income. It's a really simple to understand formula. But he also said that you could replace the development, the land, the multifamily, and the single family with things like stocks, if that's the thing that you understand and that you want to invest in, or with your businesses, if that's the type of thing that you want to invest in. You don't have to buy real estate or stocks or run your own business, but what's important is that the thing that you're investing in is something that you understand and something that is not highly leveraged. And when I asked my mentor if this is a system that only he uses or if he knows other people that use it, he said almost all of his very wealthy friends use a system that is almost identical to this to not only run their personal finances, but their businesses. They try to keep the baseline expenses of their businesses and their personal finances as low as possible, increase income as much as possible at the same time, and invest the difference. And he said that is the only system you need to know in order to build wealth and increase your net worth. And if you constantly focus on keeping your baseline low and increasing income, investing the difference, you will be beyond wealthy faster than you could ever believe.